Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard.
John, what's coming up on the show today?
Jim, today we're going to look at something that I don't really spend a lot of time on, which is the gold-producing companies. My focus is more the explorers and the developers, but today we're going to go through the gold producer index and talk a bit about when will the market start pricing the ounce on the ground companies to reflect the current gold price.
What did the second quarter reports by the gold producers look like?
They started coming in late July, and the last ones came in this week, except for the ones that are the sort of South African companies such as Harmony and Gold Fields, which are just about to produce their year-end reports. Most of all the companies have reported their second quarter, and many of them produced record cash flow. And I've just gone through all these reports and sort of checked, how much did they produce and what did they get. And almost universally, everybody has been getting between sort of $3,100 and $3,400 per ounce sold. So only one of them, Poor Centera, has a streaming contract, which ended up with a lower price of $2,793 per ounce. And of course, that's the price you pay for streaming, which is why there is an appetite to provide money by streaming companies because they are collecting the spot price from the gold. So so for the past few weeks, we have seen a significant change in the way the market is treating these gold producers, both the mid-tier and the top tier. Now, I started this index on basically January 1st, 2020, to cover companies producing more than 100,000 ounces annually. And what was distressing, except for sort of a brief period in 2020 and into 2021, the gold price trend, with the same baseline, has outperformed the index as a group. But now the index has started to punch through. In fact, as of Thursday, it was up 126.2% compared to gold up 119.6%. And this is an important milestone I have been waiting for because from sort of 2015 on, the gold producers lost their status as leveraged proxies for the price of gold. It used to be that the market gave them a much higher premium than their base metal peers, but that ended around 2015, and by 2020 they were actually lagging the price of gold, even though gold has been pretty much on a tear since 2022. So I've gone through all those reports that they've done and sort of grouped the companies into those which have been outperforming the gold index for the last 2 years, those which have been sort of tracking it, but not really punching through, but are recently showing signs of punching through. And then I'm going to mention the laggards, the ones that have underperformed the gold trend line. So all of this with the written portion that I will publish on Substack, I'll have all these graphics there for people to look at. I don't do the analysis of looking into the fundamental details. There's analysts with six-figure incomes who specialize on that and pay close attention to it. My interest, as I said earlier, is more the earlier stage ounce in the ground or plain old exploration plays. So let's start with the ones that managed to outperform the gold index in the last 2 years. And I'll start with the ones that I called sort of the majors, top tier. And these are ones doing 500,000 plus ounces a year. So the outperformers have been Gold Fields, and I'm just going to do it alphabetically, Eldorado Gold, Harmony Gold, Kinross Gold, and Perseus Mining, which is both listed on the ASX and the TSX. The next group are the ones which have been sort of tracking the gold index but below it, but are now starting to punch through. And the one I pay most attention to amongst the 500,000 plus annual producers is Agnico Eagle, and it has now punched through. And other ones on this list are the Anglo Gold, Ashanti, Evolution Mining, and Oceana Gold, which recently did a 10-for-1 rollback. The ones that are the smaller ones are are Hecla Mining and IAM Gold, Ramelius, and Torex Gold. Now, the ones I forgot to mention earlier, now that I'm thinking about the ones that are the most lucrative performers, the 100,000 to 500,000 ounces, in the outperforming group, here's the list. There's Capricorn Metals on the ASX, there's China Gold, there's Dundee Precious Metals, there's Lundin Gold, which has been a spectacular performer, and New Gold, which has also done extremely well. So now we look at the North American laggards. Amongst the big ones, no surprise, there's Barrick Gold and Newmont, and then we also have Endeavour, also with a 500,000 plus ounce. All of them, their trend lines are still underperforming gold. And amongst the smaller group, the list is Centerra Gold, Coeur Mining, Equinox Gold, Galiano Gold, McEwen Mining, SSR Mining, and Westo. And when we shift to the Australian batch, there we have the Resolute Mining as a 500,000 ounce plus producer. It's been lagging terribly. And then amongst the smaller ones, there's Northern Star, Regis, St. Barbara, which has done super terrible, and Vault Minerals. And ones that I can't really talk about under or overperforming are ones like Artemis Gold, which just started production short while ago, and it's coming in also getting the spot price, and so it can't. There's no data because they just started in May. I added them to the index in May. So the producers are starting to regain the market's attention, and it's going to be interesting to see what happens during the rest of this year. I do think there's still a concern that gold's uptrend is going to reverse. Gold has basically been tracking sideways between 3,200 to 3,400 for the sort of second quarter heading into the summer, while the producers have been demonstrating that, this price, we're getting a big windfall. And the question is, are we going to start dreaming about $5,000 to $10,000 gold? In which case, if people start believing that, then we'll start seeing the producers priced as the way they used to be, as leveraged proxies on the price of gold. But we're still in that in-between period, but the market is definitely warming up to the idea that these producers are stocks to own and have higher prices yet to come.
When will the market start pricing ounce in the ground, Junior, so that the value reflects $3,000 plus gold?
That is the most important question right now because, for example, my Vista Gold, my favorite, which is permitted, Mount Todd project in Northern Territory, it's permitted, and it's being priced at a fraction of even the recent 15,000 ton per day scenario for which they published a feasibility study, smaller scale than the early 50,000 ton per day. The stock has risen back above $1. It was $1.22 yesterday. So people are starting to understand. They're starting to map this change in the pricing of the producers to these advanced ounce in the ground type companies. But what is that inflection point? I think it's going to be probably in the new year. We need to survive the next 5 months or so to see what happens with the economy. Do the tariffs cause a considerable slowdown in economic activity? Do they cause inflation to show up? and how will the Federal Reserve act in the United States with regard to the weakening numbers? Will they drop the interest rates and increase debt liquidity, or will they stay tight to control the inflation levels? All of these are moving parts. In fact, today is the day when Trump meets Putin in Alaska to somehow persuade Putin that all the lives and money and reputation he cost Russia during the last 2 years needs to be, flushed down the toilet and retreat back. Or are we going to end up with, we want this war to stop, so we're going to stop supporting Ukraine so that you can go in there and own the country, incorporate it back into the Russian Empire, and then we can start doing business with you again. Depending on what the outcome is of today's meeting, could really dictate the trend for the price of gold. So don't know what's going to happen next week, what the outcome of this meeting will be. But with regard to the juniors, one of the good news that came yesterday was Snowline Gold, which I added to the Kaiser the favorites collection a month ago or so when they published their PEA for the Valley deposit. The stock, they just announced a $90 million financing at $9. That's not much dilution. It's a lot of money. And then some people are sort of wondering, they're raising this much money. Does this mean there's not going to be a buyout for that company anytime soon? And there has been speculation. In fact, one of the pieces I wrote earlier this year was about Lundin Gold, which has done fabulous with its Fruta del Norte project in Ecuador. In fact, they recently produced some truly spectacular intersections. They keep finding more and more in that system. I speculated, this would be a good fit for them to acquire the Valley deposit. Snowline Gold has sufficient strong, large shareholders that they can resist a hostile bid. And this financing allows them to start plotting the Valley project from PEA through pre-feasibility and eventually to feasibility study. And there's been talk about, for example, Artemis Gold acquiring the Blackwater project from New Gold and then raising the money to push it into production, coming on stream recently. That has become kind of a poster child, and the Lundin Group did it also with Lundin Gold when they acquired the Fruta del Norte project from Kinross, which had acquired it during a period when the country created all these very bad mining policies. So these are examples of projects being developed, put into production by the company itself. And generally, we do not like that scenario as investors because it takes years to get all this stuff done, get all the feasibility study and permitting work done, and then building it, and then cost overruns. When IM Gold acquired the Cote project, the capex ended up being double what they anticipated, and so that was almost a lost decade for IM Gold building that mine. That's now in production, and that's going to make them a lot of money because gold is now at $3,000 plus. Right now, because of this general feeling, even though the gold futures curve all the way into 2030 shows $4,000 plus for gold, this concern that gold is going to retreat, the market is inclined at the moment to give the producers some slack and start pricing them for this $3,300 an ounce that they're getting at the moment. And the longer this happens, the more comfortable they will get with the idea of $3,000 plus gold. But the urgency to acquire, say, a Vista Gold or a Snowline Gold, that's not really there yet. They have been merging with each other, but now that the market's waking up to this, all the companies are ending up fairly priced. And so really when you merge several mid-tier producers together, it simply adds up. There's no real gain in the value of the underlying company. So at some point here, when they get comfortable that $3,000 plus gold is coming. Are we going to get that same sort of thing we got in the 80s after gold marched from $35 and stabilized around $400, where Doug Casey predicted fiat currency debasement, and he and along with the Aiden sisters were talking about $2,000 gold, imminent $2,000 gold. Well, gold was basically stuck $400 plus or minus $75 for the next 20 years, and that never happened. The equivalent today would be, gold going to, 3,000 times 4 or 5. That's $12,000, $10,000 plus gold, somewhere in the $10,000 to $20,000 range. But I don't think the market really will buy that story. So having producers priced as with a sort of leverage to the idea that gold's going to $10,000 to $20,000 without hideous inflation, I don't think that's going to catch on. So at some point, the producers, market's going to look at them and say, okay, you have these mines, they are depleting. Yes, you're getting this big cash flow windfall, and that's great. You're using the money to buy back your shares or even do dividends. But you're basically a dying company unless you come up with growth. And they're not very good at doing their own internal exploration, so they are going to have to go on the acquisition road. So the big game right now is for the ounce-in-the-ground projects like Snowline's Valley and Vista Gold's Mount Todd. It's for these companies to carry on with their permitting. In the case of Mount Todd, they will have to do some modifications to the existing permit so that it can be ready if somebody wants to put in production. In the case of Snowline and Valley, they still have to go from PEA through PFS into the final feasibility study and do all the environmental baseline studies and so on. And the $90 million financing they did is very, very smart because it'll take them several years to spend that doing the feasibility demonstration work. What we really don't have yet is the kind of market we had in the 80s, not the 80s, the 2000s, when the big scores were all made by companies that acquired projects that had ounces or pounds in the ground that attracted the institutional audience, which started crunching the numbers and seeing, China's driving the price of copper up, gold is going up because the structure of the world is changing, it's going up in real terms. So these projects will end up being the money, and the appetite by the producers wasn't yet there to acquire them, so the money went into those treasuries to spend on that feasibility demonstration work. So the fact that this money came into Snowline pretty close to the recent high it accomplished, this is a sign that the institutional capital is starting to take the $3,000 plus price of gold seriously. And they know that at some time in the next 12 to 18 months, there will, if gold has not collapsed below $2,000, making all these projects not worth anything, they do know there will be pressure on the producers to start growing by acquisition. And in the case of Snowline, what they have got going is they have a very large land position in Yukon, only recognized within the last 4 or 5 years for having these higher grade intrusion-related gold systems, and it was never really expected to find something like Valley in this part of the Tombstone gold belt. So they can spend a lot of money exploring for additional deposits, and even if gold just stays stuck here around 3,300 for the next few years, they can grow the value of the company two ways. One, it's the market starting to apply the $3,000 plus price to the economic study model, the discounted cash flow model, and price the stock accordingly. And if they start discovering similar deposits, those will end up being additive to how the market will value the company. So raising this money, I think this is a very bullish sign. It shows the institutional capital is coming back into this sector. It's great for Snowline because, in my view, it should be trading in the $15 to $20 level range, given what the PEA said about their project. And in the case of Vista Gold and Mount Todd, I think they'll have the technical report for the 15,000 ton per day scenario published probably by the first week of September, because we see all of these gold shows starting, and then Beaver Creek, all that starting, I think, in the second week of September. So they're going to want that out there, and they'll want to be able to show the project to a much broader range of producers, so the mid-tier type producers. And that's where I think the big magic will come, where when these producers start being priced even higher as the market takes $3,000 plus ever more seriously as a new long-term reality, then they will start competing to acquire the Mount Todd. Now, Mount Todd would take a couple years to put into production. Snowline's Valley would probably take 5-6 years to put into production. So there might not be such a hurry to do that unless they start having this fear of missing out and being out, competed by their peers. So I think we're heading into a great period. I did 2 interviews a week ago, one with Bill Powers of Mining Stock Education, another with Charlotte McLeod of Investing News Network. These actually generated a lot of interest. A lot of people signed up for the free Substack, the Kaiser Research Substack, and a surprising number are actually paying the $10 a month or even the $100 to get the 12 months. So there is a good vibe out there that finally, we are going to see much broader interest in the resource junior sector.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard.
Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.